we started investing in 2012. We're currently just started investing our Fund 6 earlier this year, and we have around 2,000 portfolio companies.
2,000 portfolio companies.
If you had asked us in 2012 what we do, we would have said we invest in companies raising sub $500,000 rounds, mostly at sub $3 million valuations. But virtually everything we invested in back then was pre-revenue, because in 2012, 13, it took $500,000 to $1 million to build a first version of a software product. Usually, in today's world, my answer would be that we invest in companies raising sub $500,000 rounds, usually at $2 to $4 million valuations. But the difference is, in today's world, every company we're investing in, for the most part, has revenue at the time that we're investing.
Hello, and welcome to Fireside with VC. My name is Andrew Romans, and today we're with Dave Lambert, who is a co-founder of Rightside Capital Management. I'm actually really old friends with his co-founder, Jeff Pomerantz. Love these guys. I even helped raise some money from one of our Japanese LPs into one of their really early funds a very long time ago. What Rightside Capital Management does, and Dave will tell the story, is I call it pre-seed. I mean, Dave maybe has another term for it, but they're investing in companies with very little revenue, like 5K. And I think a pre-seed is even investing in no revenue, but I don't think that's really what you guys are looking for. And when you're investing that early, there's going to be a high failure rate. And so the logical response to that is to increase the level of diversification. It's maybe more than most civilians would begin to believe. But Dave, thanks for coming on the pod. Let me just open up with this question. How many portfolio companies have you invested into through Rightside Capital Management since, I think, 2012? I think is when you guys got going.
Yeah, so we started investing in 2012. We're currently just started investing our Fund 6 earlier this year, and we have around 2,000 portfolio companies.
2,000 portfolio companies. And I mean, is it okay to talk about fund size? Like, so so what was the size of Fund 1? And how many companies did you invest in out of that first fund? And how long did that take?
Fund 1, we invested over 3 years. Very small proof of concept fund. It was like a $6.5 million fund, 279 companies, actually. Little tiny pieces into lots
279. Yeah,
and then our current Fund 6 is going to be larger, more like 100 million. So,
oh wow,
it's still small in the scheme of venture. Very small, but pretty large when you're deploying. Just a small, 100,000 at a time type of.
Yeah. So so I mean, let's maybe talk about some learnings from the past, but go straight to today. What is average check size? And or explain how you see you guys fitting into the market. What's the role of Rightside Capital Management? What's the thinking and the thesis?
Yeah, that's a good question. So you had referenced us as being a pre-seed investor, but we actually refer to ourselves as being a pre-VC stage.
I saw that on your website. Yeah.
Yeah. And what it is, it's that pre-VC term doesn't refer to necessarily the level of traction that companies have. But if you look at what the dynamic of what most pre-seed stage rounds look like, they're still mostly $1 million to $2.5 million funding rounds. So they're rounds that are pretty decent size. And in the entire startup world has gotten incredibly capital efficient. Really, it's this trend since 2010, where the cost to build your first version of a software product sort of, driven to almost zero for a lot of founders. And there are a lot of founders who are just looking for small rounds. And for the most part, the professional investor world just completely ignores all these little small rounds. It gets challenging to address sub $1 million rounds for the venture world, let alone the sub 500K round size world. And so we think that part of the entrepreneurial ecosystem is really robust and strong, and demand's growing every year. And yet there's no really good answer from the professional investment world. So what we do is we focus entirely on companies raising round sizes that are generally 100 to 500,000. So we're really talking about the round size. It turns out that the cream of that crop in today's world, they have live products generating revenue. They're usually somewhere between, 5,000 to maybe 30,000 plus a month in MRR.
I remember Jeff saying, and I saw on your website, you're saying 4 million pre or sub 4 million pre-money valuation. Yeah. Jeff used to talk about 3 million pre. So I guess there's been inflation at the the grocery store and inflation in San Francisco startups, but I always thought it must be really hard to get somebody to drop the valuation to 3 or 4 million. What is the range of valuation that you guys go to? I think you even said you'll pop up to 6 for extreme traction.
Extreme, yeah. So if you had asked us in 2012 what we do, we would have said we invest in companies raising sub $500,000 rounds, mostly at sub $3 million valuations. But virtually everything we invested in back then was pre-revenue, because in 2012, 13, it took $500,000 to $1 million to build a first version of a software product. Usually, in today's world, my answer would be that we invest in companies raising sub $500,000 rounds, usually at $2 to $4 million valuations. But the difference is, in today's world, every company we're investing in, for the most part, has revenue at the time that we're investing. So I would say it's sort of the opposite of that inflation number you said. I would actually say, if anything, it's a pretty similar investment profile, but companies are noticeably de-risked because they're much farther along. I'd say 30% of our companies died that we invested in back in 2012 or 13 before they even reached the level of traction that we invest in today's world. So, and to answer your question, basically, we have this incredibly fast, transparent funding process. So if you go to our webpage, you go to the submit page on our website, we list exactly what our target investment profile is. And then we have this fast, transparent funding process where we can be a quick yes or no, usually anywhere from a couple days to a week. And it turns out that's the investment product that entrepreneurs covet, and repeat entrepreneurs appreciate it the most, because we're saving somebody in today's world 5-6 months of full-time fundraising to get a round closed. And instead we're coming in and we're able to give you a firm yes or no in a week and close and go, and you have that time back to grow your business. And then the second thing to understand is that, most of the companies we're investing in have been incredibly capital efficient. They've bootstrapped the company and have raised no money before, or very little. Right. So, valuation matters much less when it's a small round. If you're raising a $300,000 round, valuation doesn't matter like it does if you're raising $1.5 million round. And to get this fast, transparent process, and to get an investor on board who's seen the life cycle of 2,000 companies and has expertise at all different stages and brings a lot of operational resources that are available to you as well. It's just, you can't get that anywhere else. Yeah. So it's just really offering the right product that, it's product market fit. It's like the definition for a certain profile companies, we're the best things in sliced bread.
So just to understand some quick, how the whole kind of asset class works, what would you say is the total loss rate? What percentage of the logos you invest in go to zero, since you're coming in so early?
It's interesting. It's actually much less than we had estimated. If you had asked us in 2011, before we went live, we would have said our loss rate would be potentially up near 70%, and that a lot of our investments would fail quickly, based on how early we're investing. We could have a lot of failures in the first 18 months. And it's been amazing how both those have been dramatically wrong estimates. I'm guessing I still believe our failure rate will probably be about 50% long-term, maybe a little over. Like, we're fine with anything up to 70%, but it's our survival rate of our companies is insane. It's just incredible. I mean, I was an entrepreneur for almost 2 decades in the 90s and 2000s, and yet I'm still constantly surprised at how sort of scrappy and, and the survival characteristic that a lot of the top capital efficient companies have. So, I wish I had the numbers at the top of my head, but even after 5 years, our survival ratio is like, 80% or some crazy number. It takes a really long time for companies to die. And that just means they're out there in the world, pivoting, changing, trying different business models. And, we have companies take off 2 months, 12 months, and 3 years after we invest. You just don't know.
Yeah. I mean, it takes a long time to see the end of the movie in venture capital, and wisdom kind of comes in later years. We started investing in 2014 out of a normal fund, but I was doing an equity exchange fund since 2006 and been involved in venture really since the mid 90s. But I heard Hans Swindlin from Industry Ventures once say, if I see a VC who's got a total logo loss rate, So not the percentage of the fund, but the percentage of companies you fund that go to zero. You might put more money into your winners, right? He said that if I see that they have a loss rate below 30%, I won't invest in that fund. And at the time that he said that, I said, oh, damn, we're not taking enough risk because our loss rate is closer to 20%. Give it time. Give it time. Give it time, and you may find your loss rate was maybe even higher than 30%. So that's interesting. So you think this many years in, 12 years in, it looks like for the stage you're playing at, it's a 50% total loss rate. Yeah.
I would say overall, yeah. I think by macro environment, the range of sort of the middle 80 to 85% of macro environments, which includes recessions and things like that, it'll generally be somewhere between 40 and 60%, but the thing is, it doesn't matter that much whether we have 40, 50, 60, 70%. Right. The returns are driven by the large winners. And one of the things that having these ultra diversified funds does with hundreds of investments is there's no amount of risk we can't take because we're just doing a small investment. And it's interesting because it gives us the power to invest in things that it wouldn't be rational for other people to invest in, because we're investing in profiles of companies. We take a company, and this is the biggest epiphany for me when we started the company, because me as an individual investor, and really what almost every venture capital firm does, when you're diligencing a company, you're trying to figure out if that specific company will succeed or fail. I mean, that's just what you're doing. And at Right Side Capital, that's not what we're doing at all. We turn a company into a profile. And then we're trying to figure out, we're assessing, would a pool of 50 or 100 companies of that identical profile, at these deal terms, how would that whole pool perform? And if that pool is going to perform well, we're investing. And it's not like there's some magic single profile that we're going for. There's lots of different profiles that if you did 50 or 100 shots on goals would work. The difference is just that we'll actually get 50 shots on goal for almost any profile. So we can do that, and the math works out. And it's just really healthy for the entrepreneurial ecosystem, because it just allows us to invest in things that other investors aren't investing in. And it provides capital in these early segments where it's needed the most. And there just aren't other real sources of capital out there. That's what we do.
It's a different game because if I spent a lot of time with Dave Sabota, who's on the corp dev team at Google. So he does M&A acquisitions for Google. And I asked him, how many companies have you acquired at a price below 50 million? And he's like, oh, like before, during, and after lunch every day. Like we buy all these tuck-ins and these quick little acqui-hires and team buys and stuff like that all the time. And I said, how many companies have you acquired for over $1 billion? And he's like, well, I can name them right here. And he comes out and tells you the number of companies that he acquired for $1 billion. If you invest in a company as a VC at a pre-money valuation of $100 million, and you want to make a 10x return, you have to get liquid at $1 billion with no funding between now and then. And normally, if you raise money from like Right Side Capital, they get introduced to 7VC, and then we introduce them to somebody else, and there's going to be many funding rounds. And if they're selling 20%, 10% in these rounds, you can expect kind of 50% dilution. So you got to get a $2 billion exit to make a 10x return on a 100 million pre, if that's your entry point. Whereas with you guys, if your entry point is like 3 to 6 and hovering around 3.5 or something, if the company doesn't raise any money and it sells for 50 million, it's a pretty good exit. How do you think about entry point, dilution, and terminal exit and cash on cash returns?
So you're right on all those fronts. So a couple interesting things. I would say there's 2 points that you brought up. One has to do with companies where the business model doesn't work out. One of the things we were completely unaware of when we launched is what percentage of our companies we'd invest in that we would have thought would be total failures. Like the business model didn't work, but it turns out they raised not that much money. Maybe it was just the money from us, or maybe it was 600,000 total.
So keeping the capital stack low is part of the model of how you're making money. And they can
sell and get acqui-hired at a company, and maybe we're getting anywhere from half our money back to 2 or 3x, and it's a good soft landing for the company. And the founders get jobs and extra stock and some extra, more than they would if they just went and got a job there. And that happens to a surprisingly high percentage of our quote unquote failed businesses. So that's good for us, but it's even more importantly, it's great for the founders. And then, your question there, I mean, ultimately, when you have hundreds and hundreds to thousands of companies, your tail winners look very different. So like some of our largest winners are companies that hardly ever raise from venture capital, and then the cash on cash multiples are highest. Most importantly for the entrepreneurs, they end up owning this huge percentage of their business. And, once you're even over 100 million, the returns for those entrepreneurs can be crazy. Once you're over a billion, it sort of gets insane. And, it's very different if you are worth 3 billion and, the founding team owns 13% versus 57% or 67% company. And that's just the law of large numbers. Like, it's not like we've got dozens and dozens of those, but we always will have a few. It's just how the math plays out.
Yeah, if you drill for oil 2,000 times around Bahrain, you're probably going to hit something. What's the biggest cash on cash multiple you guys have ever made with that many shots on goal?
I'm not sure if we're I would love to just say everything about our returns, but I don't know that to what extent we're allowed on SEC stuff.
Oh, really?
But I'll give it, yeah.
Because have you made 100x on something?
Oh yeah, we've made it. Well, I can say we made over 500x on something.
You made a 500x plus on something.
Yeah. We've had an investment where the second half of our position that we sold was between 500 and 1,000x.
Okay.
Yeah, and I think on the whole investment, I can't remember off the top of my head. The whole, including the first half, I actually don't remember off the top of my head. It was somewhere around there. But
I remember your partner Jeff telling me once that you guys funded a company at one of your low valuations, and then they raised a round from Andreessen Horowitz, and you guys sold 50% into the round, which struck me as high to be selling. I might have done like 5, 10, 15, 25, 30%, but Jeff did 50, and that was probably putting good DPI points on the table to raise the next fund or something. But what's your thinking on
just to be clear, this was the early 2010s, and it was a very large round. So it was like a 24x.
You remember the deal I'm talking about?
Yeah. And it was a 24x return, for the half that we sold. Yeah. So it wasn't like we were taking 3x off the table.
It's almost rude not to sell something, right? So I mean, to show your LPs that you're not Bernie Madoff, just taking their money. You gotta wire the money back.
Yeah, our philosophy is, it depends. I would say that if we look at, we've had, I don't know, a couple hundred exits over the life of our existence, but the reality is, like you mentioned, there's only so many exits, when you get to these large numbers, and so the vast majority of our liquidity has come from secondary sales, where we're either selling into later stage rounds or we're running a process just on our own and selling a position of a company. And sometimes it's a position of a company that people in the secondary market, otherwise it's really hard to get because they've hardly raised rounds. There's not a lot of stock sloshing around out there. And it's just non-offensive to the company or to later stage investors. If someone who invested so early like us is looking to sell some, if you're a Series A investor and you're selling into a Series C round, well, that raises red flags to everybody. They're like, well, you know a lot more about this business. If you're selling, why am I buying?
Right. So is that, so did I hear you say correctly? The vast majority or more than 50% of the distributions you've made to LPs came from selling shares in a privately held company on the secondary market?
That is correct.
Wow. So you guys are experts. Maybe tell me how, let's talk about this. I think selling in the secondary, go ahead.
An interesting thing, because you had brought up like, hey, why would you sell so much or do this? And we've had every outcome you can imagine. Like, we've had lots of companies where we've sold 25% or 50%, and the companies rocketed up to much higher valuations after that. So like that one company I mentioned where we sold the last half for a crazy multiple, we'd sold the first half 18 months earlier and it went up 5x between then. But we've also had plenty of companies where we've sold 25 or 50%. And maybe we did that in 2019, 20 or 21, and their valuations plummeted by 80%, or they nosedived to zero eventually. Like, so, when you're going to do that, you just have to be okay. Like if you're selling part of your position, you're actually rooting for the case that a year or 2, 3 years later, you look back and think that was the worst sell ever. You want the rest of your position to go up a lot, so it's just an interesting, you just can't be bothered by the
we sell in the secondary market more than anybody I know other than maybe you. Like, I think you guys are maybe the only guys that are more in secondary as an exit strategy than 7BC Venture Capital. I love to quote JP Morgan. JP Morgan literally, like, I put this at the front of my M&A chapter of my first book. I made most of my money selling too early, JP Morgan. That's a
That's a
real
brilliant. Yeah, yeah.
and the older I get and the longer I'm in this game, the more wisdom I see in that. Sometimes every time you sell early on the secondary market, you think, oh, I'd rather kick myself in the nuts than do this, because now they're raising like 100 million round. It's $1 billion valuation. They're going to double revenue with this money, right? They're gonna spend more on CAC and hire more salespeople, integrate more workflows and API into more stuff, and they should be able to 2x revenue, which, second grade math says that this company will double in value. Time has taught me that sometimes when we sold in the secondary market and I thought I was leaving money on the table, that was like the best money we got out of it. And
Yeah.
they can foie gras overfund or get on a higher burn rate, and liquidation stack is growing. There's a million things that can go wrong. So selling early, I think there's huge wisdom in that. So that's interesting. What have you learned of what to do and what not to do? Like, do you ever try to wait for the round to close and try and sell above the post, and you wish you had sold into the round? It sounds like you were running your own process. What does that look like when you're running your
It,
own process?
it's been a little bit of almost everything you can imagine across a lot of companies. So I'd say a lot of selling into a round. Like if you think of 20, get to the 2019, 2021, there's just most rounds that were Series B or later had a lot more capital that wanted to invest in them than was available. So that was always, that was an option a lot of times. Occasionally we had companies, maybe that would go down the private equity route or go some other way, and maybe there'd be just some offers by an existing investor at some later stage. Hey, anyone inside want to sell for X amount? And we can do the math and figure out if that we think that's a reasonable valuation or not. And a lot of times the answer is no. And sometimes we're like, yeah, we think that's fair. That's yes. And sometimes we just run our own complete process, which is a lot of work. But if, the thing is, when we invest in lots of companies and everything starts out as like less than a percentage of our fund and something grows large, one of our sort of fundamental premises is diversification. So it makes sense to take a little off the table and not have one company be such an exposure risk. And so in that instance, yeah, we're going and we're reaching out to some secondary firms, but also to a lot of like direct family offices, just individual buyers. And we're trying to run a process, get people educated, and see if we can get multiple bids. It's
Yeah.
just no different than a company fundraising or looking to sell themselves. You're trying to get enough interest on the other side that you actually have sort of efficient price discovery, and you find out
It's a lot of work, man. I mean,
yeah.
I feel for, we've done it too. And there was a point in my life that I was under a broker dealer actually doing secondaries, where I was brokering the secondary. So we've got like a massive database. We can maybe collaborate on that sometime. That's interesting. So switching gears back to entry point investment, if there's founders listening to this, what is the range of profile? What are you looking for to pull the trigger and make an investment? What's the range of check size? We talked about valuation, but what's check size and what do you look for?
Typically we can be anywhere from like a $150,000 to $500,000 check on the high end. Most commonly we're 200 to 300,000,
And the
and
size of the round?
the size of the round is usually anywhere from just the money we put in. So, and sometimes we'll go down to 100. It could be anywhere from 100 and it's just our dollars to up to 500. We'll occasionally make exceptions and maybe invest in around up to like 750, but that's companies that are well above our target traction level, and it's probably around going off at that $4 to $6 million range. But for the most part, it's companies raising $100 to $500,000 rounds, usually at $2 to $4 million valuations. You got a live product generating revenue, and
what's the range of revenue that you typically see?
And today's world, 5 to 30K plus MRR in those
$5,000, $30,000
yeah
monthly.
And then the data points that we're looking at and gathering up, like we care about, all right, what's your revenue traction? What's your growth rate? What's your business model? What are your unit economics? If you're a B2B SaaS company, is your sales price high enough to be Salesforce driven, or does it have to be marketing self sign up driven, which is and get the math to work out? So we'll have different requirements of traction and different things we look at for those. how much capital have you raised to get to that point in time? And what's your current monthly cash burn? And then a whole host of things about the founding team.
What kind of dilution? I mean, I'm sure it falls all over the map with so many investments, but what's typical for how many funding rounds your portfolio companies raise after your entry point check?
Yeah, it's a good question, and it varies immensely just when you have so many companies. And just the question of dilution is an interesting one because we have zero emphasis on ownership percentage on the way in, and all we care about is what's just like a public stock. What price did you buy your share of stock at, and what price are you selling it at? So
we've always, by the way, said that, and we find institutional LPs are completely dazed and confused when they hear us say that.
Oh, totally.
Like they don't get it. They don't get it. And I'm like, what's not to get? You bought Apple at this price and you sold at that. What is wrong with your second grade brain?
If I always say it's funny, imagine this sort of thought experiment. If you were a manager of investments for public investments at some large endowment, and you went to the investment committee and you said, oh, we own 1% of Oracle, and they just acquired a company and issued 3% more shares. I think we need to buy 3% more so we still own 1% of Oracle. You'd be fired. You'd be laughed out of the room. But they would be like,
what they all say.
Why do we care about that?
Yeah. Well, so those ownership targets that the big funds have plays nicely into your strategy and ours, because if you ever raise your hand to sell on a secondary, it's hoovered up by that target ownership percentage model that they have. And so in general, do you see 50% dilution in some of the ones that really get into the venture track? I mean,
yeah. If they go,
we kind of model for 50 to 60% dilution.
It's anything's possible. I mean, the thing is, we have anything from some companies hardly raise anything after us and get profitable and get huge, and we've had hardly any dilution. Like we might have 20% dilution, even though we're in crazy early for a company that's way up and huge. And we've had companies, I remember a company I think we had invested in at 3 million or 4 million, and they sold for 200, and we made 8x because they had raised like 64 million along the way. Right.
Yeah.
You just, and so the important lesson is like anything that's affecting our returns like that is affecting founders' returns too. Like a lot, it's not, the founder world is sort of brainwashed into thinking that, if you raise a large round from a known venture firm, that's a success. But another way to look at it, as a career entrepreneur, you could look at it that every funding round you do is a failure because you're not yet to a point where you're profitable and you can sustain your own growth. So, there's not a right or wrong. There's very different profiles of companies and growth paths. But yeah, it's a higher risk profile when you generally go down the venture path, because we're in this unique period right now where venture capital really cares about capital efficiency suddenly again, because that's what always happens when the bubble pops and the new cycle starts. But that'll stop within a year or two from now, and it'll all be about growth. And it doesn't matter whether you have 1 million, 10 million, 50 million of ARR. If you're on any company that's on a high growth, high cash burn trajectory, boy, it just takes one speed bump to blow everything up.
Yeah.
And that's fine. It also puts this larger tail in play that the crazy good stuff happens. But I don't think most entrepreneurs really appreciate that extra risk that comes with those larger rounds and that high growth.
When I was running the Founders Club, it was an equity exchange fund. So, a company raises money from Benchmark Series A, they think they're in the end zone. And I'm like, dude, the risk just got really rough for you now. Like you should maybe diversify and swap shares with 24 other companies. So like we've always had that kind of, perspective.
That's something I think is just awesome for the entrepreneurial world. Because I know when we started in the beginning of the 2010s, the concept of founder liquidity at some point in the life of the company was so frowned upon. And it was just believed that if you give founders any taste of, dollars, they're going to be less hungry, and it won't, it's bad for investors. And I think people came to realize that actually it's the exact opposite. You give founders some early liquidity, and now they get that taste and they want the rest even more. And now they're not financially stressed as much. And it's not this red flag. And I think it was largely driven by fund size is getting large and lots more dollars wanting to go into these later stage rounds. So they're like, well, if this is the only way we can get extra ownership, we're okay with it. But I think it's just actually better for founders and investors. So from like the mid 2010s to now, it's a little less common now just because the bad funding market. But we've encouraged tons of our entrepreneurial teams, once you get to some larger rounds, like, hey, you should be taking a little bit off. Like this company can still go to zero, and boy, are they happy.
It's a very complex topic, and I continue to move around on my view of this. In recent years, founder liquidity to me has become the enemy of my VC fund. I think that when I see a founder taking 30 million off the table, she doesn't want to IPO. And like, a question I wanted to ask you a few minutes ago, which we can get into, is what percentage of your companies, because you have so many, you're like a data warehouse, just seem like they're never going to exit. Like they just carry on forever. And you're like, why don't you sell this company and get on with your life? And, these funds are supposed to be wound up after 12 years. And you're like, she is never going to sell. I mean, they just enjoy being CEO of this privately held company. The growth is not that great. VCs are like, not interested. They're profitable. And when I see these big founder exits, I'm like, they never want to go public. They should go public. Why don't you IPO? There's demand. It's not a lack of demand at JP Morgan, Goldman, and Morgan. They're willing to IPO companies. It's that the founder just took 30 million off the table. Why should she go public? To me, these secondaries are becoming a problem. Believe me,
that large is different. I was talking about like taking 3 million off the table.
3 million. Yeah, I mean, it's
30 is a little different, but
I mean, you went to Stanford. A lot of these guys, like, it's time to go to Lake Tahoe, and your roommate has a cabin in Tahoe, and you can hardly afford the lift ticket, and yet you're worth 30 million on paper. Sell 3 million, and you can at least pay for the lift ticket for your children, and stay at your roommate's house in Tahoe. So I understand being a founder. I mean, you were a founder straight out of Stanford from '92. So I think you had 2 startups before Rightside. Is that right? So you've been in their shoes. So you and I understand this better than, maybe like a Fred Wilson, who was never the founder, just always the VC. But I'm finding lately, I'm not all for huge liquidity programs and stay private forever, because we have to exit these companies at some point. Our LPs deserve liquidity. I mean, we talked about that with secondaries.
Yeah, so I think it's more of an issue in today's world where just multiples are compressed and are very low, and I think it's in the long term, over long periods of time, it's not a big issue for us and less of a concern. Because what happens is, if you're investing in cash flow businesses, then there's always this big risk. And it might be even rational for an entrepreneur to want to keep running this and kicking cash out and doing all that. In general, if it's a tech business, a SaaS business, and it almost never makes rational sense to start paying dividends and kick dollars out when you can reinvest that and have that profit and have higher growth, because you get a good multiple of revenue on an exit. So we have found that generally not to be an issue. But that being said, the last 2 years, when multiples are suddenly a lot lower than they were before, who wants to sell? None of our companies doing well want to sell, and that's totally understandable. But I think as time goes on, either multiples will go back up a little, and they will, or people will realize, hey, this is the new normal. And still, even if 7x feels low, that's still high in the general scheme of things. Like that was a high multiple in 2015, relative to kicking out the cash and having all your eggs in one basket. I don't think it's a huge risk. I think what's interesting is that across our really early stage portfolio, we have the exact opposite problem. Like the question you asked is something we get asked all the time, like from potential investors or just other people that are interested. Aren't you worried that a lot of your founders are going to turn these into lifestyle businesses and do this? And I would say we have sort of the surprisingly opposite problem, where we have lots of founders, and sometimes who we feel have like proved multiple times over that this company and business model is not working, and they're living off of ramen and keep trying to make this work. And our view is that you should probably just have us take the zero, and you should move on with your life, and you should start something else or do something else. And I mean, the number of companies we have where I think entrepreneurs put an irrational amount of work and time into making something work that probably has been proven that it won't work is amazing. And I think it's, so if anything, I think we tend to see the opposite. Like the entrepreneurs are just so determined and, strong-willed that oftentimes they're not able to notice when, hey, I've actually proven that what I'm doing is probably not going to work. So that's our interesting insight, is we feel there's actually the opposite problem generally in the entrepreneurial world.
Well, I wish I could say the same, but it's not our case. I mean,
yeah, and maybe it's just a different segment of the ecosystem we're in. But what you said does play in, like that. We've had a big winner where the entrepreneurs were just hadn't raised much capital, very successful business, very profitable, and they were just fundamentally leery of investors, right? So it was not going to be appealing. They weren't going to ever raise a large round because they didn't need to, and they didn't want more investors. And very unlikely they were going to go public. So like that's one where we in a few different times we sold and eventually sold out on the secondary market.
Okay. And so how many exits have you witnessed through Right Side Capital now? I mean, what's the total number of companies you've invested in? 2,000?
Yeah, 2,000. Gosh, I should know the number of exits that we've had.
Okay.
I don't know. It's probably up around 200. But realize 200? It's like, and when you have tons of exits, what does that look like? Well, the largest number looks like us getting back anywhere from 30% to 2x back, right? That by definition, that's going to be the biggest number of those exits. And then there's
a lot of 30% to 2x's.
Yeah. And then as you get higher up, you get things at much higher multiples, and those numbers go down. Like it's an outlier driven, return world at these very early stages. There's just no way around that.
And so your portfolios are the opposite of concentrated. So when you do get a big, outlier Google Groupon huge exit, it's weighted down by many, many, many other. It was a small check weighted down by many, many other checks. What do you see as cash on cash DPI in the end of winding up a fund for your asset class? Maybe not what you're really hitting, but what do you think you're going for? Like, because I would imagine that if you are like kind of Ron Conway-esque of doing what you guys do, for the LP putting money into your fund, there's really, it's illegal to say it, but there's just like no way you're going to lose money. You're just so damn diversified. You're not going to lose money. And on the other hand, if you run around with a shotgun shooting everything, you're going to hit something. But it's weighted down. So there's kind of a cap on how much you can make as well. So that's my own thinking about the asset class that
is completely correct. Unfortunately, we're one of the rare firms. We're actually an SEC registered fund. And even though we're probably have more scrutinized, I would love to be able to, at some point in the future, probably when there's no fundraising going on, I can talk about all of our returns and just give you every number of everything. But unfortunately, since this is a public video, I can't say any of that. Okay. What I can tell you is that our target return profile is a range that's higher than the average, the traditional medians and averages of the VC world to hit in almost all macro environments, and that our return profiles ended up much higher than our original estimated return profile when we went live. Okay. So it's all working well. Okay. But I can't say much beyond that.
And absent secondaries, what is the basic time delay? What's the distance of time between entry point and exit? And with so many shots, you probably have invested in something and it was like Instagram Instabillion and it happened quickly, or WhatsApp really fast.
Yeah, it's a really weird range of outcomes. I mean, our hope actually for most of our big winners is we want it to be a while because of QSBS. Returns. So, ideally it's very much late. We want most of the liquidity coming out of our funds in years like 8 to 11. We don't want lots. I mean, first world problem to have if you have a bunch of early liquidity, which we have had some larger transactions, but ideally we want them delayed and later so that they're coming out tax free.
Do you hold out on secondaries waiting for the 5-year QSBS typically?
Typically, but not always. Like that one we talked about, that Series A we sold into and got a lot. No, that was, year and a half later
Yeah,
or something like that.
I tell
But
myself, don't be
yeah,
greedy. Stop thinking about QSBS. Take the money, but don't do 50%. Like when Jeff told me about
yeah.
that A16Z thing, I thought, dude, 50 was too much to be selling. But you know how to manage DPI. That's how I stomach
If it's
pre
year
pre
four and a
QSBS.
half, we're going to wait. Like, so what in that one large one we talked about earlier, like our first sale, coincidentally was a week after our 5-year hold. And
Oh, really?
we started running the process 4 to 5 months before that,
Oh,
knowing that,
wow.
all
So
right,
you guys were really hitting QSBS just on the nail.
yeah, we're like, hey, it's coming up. This is going to be a huge part of this fund, much larger than we'd probably want one company to be. Let's sell half. And, the company was profitable and doing well. We didn't put it as any risk to sort of just vanishing.
Yeah.
So, even a year earlier, we talked about, all right, well, let's look at doing this and let's diversify a little bit out of this when it's tax favorable.
In general, how many investments does Right Side Capital complete per week or per month?
Yeah, I mean, you can just do the math. It's a large amount per month. So it's, it can, in any given month, it depends. It could be 6, it could be 15 plus.
And you guys are probably investing pre-demo day for most accelerators, right?
Yeah. So if we're in accelerators, we're either, we actually do have some small ownership in 2 different accelerators where we get a little piece going through. But when we're generally engaging with accelerators, we're working with the managing directors and we're coming in and talking with companies like in the first 2 weeks or 3 weeks, because we make such a quick decision. We don't distract them from the curriculum of the program. So yeah, it's almost always pre-demo day.
Yeah, there seems to be like a group of investors that try to arb. I invest in a month and a half of a 3-month program, and so my IRR looks good because they raise at a higher rate, at a higher valuation just a few weeks later at the demo day.
Yeah, I mean, we're not really doing it just for the paper markup. Ultimately, we just think it's a good investment strategy.
Well, your
And it's also
valuation forces
when,
you to go in there earlier.
yeah.
If
And
if
also
you're
it's
really
when the
strict on that.
entrepreneurs need it. Like it's hard when, the thing that we saw the most when we started talking with lots of companies and accelerators in the early to mid 2010s is their perception was, oh, you get to demo day and you raise money in like 1 to 3 months. And we're like, no, it's not true. The average company that raises money probably takes 9 months after demo day, outside of frothy times like 2019, 2020, 21, but even in normal environments, 6 to 9 months. And that's for the ones that are successful. Sure, there's going to be a few in your cohort that have a round raised before demo day or do it quickly. So we advise all companies, if you're in an accelerator, you need to have 6 to 9 months of sort of ramen runway, and more like 9, so your company doesn't die before you raise that round. And so you should be raising money, whether it's from us or from an angel investor. Don't just wait and only raise at your demo day round. Cash is time.
Yeah. That's valuable advice. And talk about what you've learned to like and hate with exits. Maybe start with exits that, like private equity investments where they're trying to fund the company and minimize what they're paying out to investors, preferred shareholders. Maybe what are some lessons learned? Or even describe what do
the
exits
things
even
that I
look like?
like least, that pisses me off the most, and this can be a dynamic both in a funding round and in an acquisition, whereas effectively the new large investors coming in or the acquirers are effectively structuring the deal. So, and this often happens without the founders realizing what's happening. So it's not, where they're effectively bribing the founders with deal structure to make the founders sell the company at a below, or take investment at a substantially below market valuation. And it's the existing investors that are eating all of that.
So like a sign-on bonus or
Well, that would be
like
something where like
earnouts and
someone comes in, I'll give a round example where an investor comes in and is like, hey, what we like to do on our rounds is, we like to top off the founders a bunch. And so let's go ahead and let's top up that options pool to 20%, and let's then grant 10% back to you. And the founders are so excited about this, and they don't know because they haven't done the multiple rounds. They think maybe this is normal, but then and suddenly they're not thinking about, oh, our ownership's going up in this round, or it's not even affected. So I don't care if I'm raising at a $30 million valuation for a company that should be worth 50, or at 100 for one that should be 150. And then most of the time, almost all the time, when we see that happening early on, I get the founders on the line and I say, hey, let me just explain what's happening. These investors are sort of bribed you by basically they're taking money from all your existing investors and giving it to you so that you'll take this below market valuation. And that stock that you're getting from that pool, that's just coming from us and every one of your existing investors. And they're just transferring it from us to you. And usually,
and what do they say back to
entrepreneurs
you
are just
there?
almost always, they're like, holy cow, when you put it like that, that's true. I never even thought about it. And this firm just sort of represented that that's sort of normal, and they do this. And then I'd say 4 out of 5 times that doesn't happen then. And 1 in 5, it still does, and sometimes you see that on a funding round too. It's like, hey, the company's selling for whatever, 150 or 350. It's 150, but the buyer couches it as a $200 million acquisition, and 50 million of the 200 is for like retention and incentives for the founders and employees they're keeping on. Well, yeah, that's a little too much, right? I believe, yes, there should be retention and incentives for employees and founders to stay on. But when you get really large, that should be shared with the whole cap table. Again, these are all exceptions. This is not we're not fighting this battle day in and day out, and it doesn't happen that much. But those are the things that bother me the most, because the entrepreneurs, like how many entrepreneurs there have sold like multiple companies over and over in this environment, or gone through these funding rounds? They don't know any better. And they're being told by acquirers or investors who know exactly what they're doing and what's happening. And I view those as sort of the bad.
Yeah,
players.
I think when there's a lot of money on the table, bad greed behavior can win the day. And good for you if you're winning 4 out of 5 of those conversations. I'm not sure I've ever won one of those conversations where I explained to the founder that this is all coming out of my pocket.
It's
and
very hard to
win
at the acquisition stage. We do have it happen when we're at like Series A and B stage. And again, because we're in the company, is often helping them with their fundraising, where it's hard. If we're getting that, and it's, the docs are supposed to be signed in 3 days, and we're just getting the cap table now and doing it, it's harder to unravel. Yeah. And we have sometimes, if it's just right at the beginning, when, hey, what do you think of this term sheet that we just got and what's going on? That's where we're explaining, well, hey, let me explain what's really going on. Yeah. And that's where we're generally successful.
Yeah. I mean, we play a very central role in helping every one of our companies raise their next rounds. And, hopefully they respect the time we're putting in, because we're not really getting paid for this. And you guys do a great job at that, by the way, showing your portfolio companies to us for follow-on investment. How many people do you have on the team right now, and how are you structured to get stuff done?
We're 12 of us. So the most interesting thing about us, I think, or one of the most interesting things is, so, I view myself as a career entrepreneur, and I just consider Right Side Capital as my third startup. Right. And actually, we view ourselves internally as a startup whose business model just happens to be funding other startups, because we're structured completely like an operating company, not like a venture firm. So the way the entire sort of venture and private equity world is structured is you have some number of partners. It could be 1, it could be 12. And their job is to be the luminary who picks the companies to invest in, and they sit on the boards and help support those companies. And almost every other role at the firm are, associates and admins that support the partners in that functionality. Well, we don't look, and we're not like that at all. We don't have partners that do that. Instead, we have just functional business units. Like, we have a team of data analysts and people that manage our whole custom cloud technology backend that we've built to manage and track portfolio companies and collect all the structured and unstructured data. We've got a platform team that helps provide sales, marketing, fundraising services. We've got a team that, triages and deals with companies on the front end that we're investing in. We've got a controller. We've got a team that deals with investor relations and fundraising. So it's just really functional business units. So where it was more challenging was the, early to mid 2010s, when we were just 3 of us, right? And we had to all do all of this. one of the things I think we were worst at that frustrated later stage investors is, in 2016 or 18, we'd have people like you come to us, no, you guys could be a great source of deal flow for me. Here's what I'm looking for. Send me companies that look like this. But when there were just three of us, it's like,
It
how
was
much of
hard.
that could we do? We were overwhelmed with how many
You're,
companies were fundraising and doing that.
yeah.
And in today's world, we have a totally structured process. We have a person, and he's just done this incredibly good job. We have a network of somewhere between 1,000 to 1,200 pre-VC stage to late stage private equity, venture and private equity firms. And we have a very structured engagement process when our companies are raising at any stage, whether they're raising a seed or a Series C round or looking for private equity. We can push their info out to 20 to 120 different investors that are relevant depending on the profile. And what's cool about that, and this works well like for you guys, is because we're talking to those investors a lot and have a good idea of what we're looking for, we're not sending you as an investor this barrage of just random stuff,
Yeah.
most which isn't relevant. It's curated, and we're only sending you stuff that's generally in your wheelhouse. So
Let me say
investors
that that has been true. I'm very impressed. I mean, in the old days, I had to like say, "Hey, Jeff, let's go meet for lunch and catch up,"
Yeah.
and come hang out in our office or something. Now you guys send me exactly Goldilocks what our band is of 100K to 500K MRR, and so I'm very impressed with the precision that you've been sharing deal flow with our team. So that's pretty awesome.
It ends up being great for everybody because it's much better for our companies now because much even higher chance of getting funded. It's much better for the later stage investors because we're this steady source of deal flow that's actually sort of curated and looks exactly like what you want to be looking at. And it's actually better for us because obviously it helps returns by doing that. But also now this whole later stage network we're really engaged with, and we're actually constantly being sent deals from them that are too early. And those people, because we're talking with them more, have a better idea of what we look for. So it just is sort of a win-win-win all around. It's just, we just didn't have the bandwidth and resources when we were younger to do that. And that was, as we got larger and had more resources, I think that the two things we recognized early on that could benefit our companies the most were providing sales help and guidance and resources and fundraising on next rounds. Because, you got a team of technical founders, they have no clue how to run an enterprise sales process or any sales process. And if we can, so we brought on someone with 20 to 25 years experience being VP of sales, chief revenue officer at B2B SaaS companies. And man, when you teach people the basic blocking and tackling early on, this makes a huge difference. To their company.
Those are actually the two things we do the most too. I ran enterprise sales basically my whole life and in software, and we have a whole bunch of LPs that are doing it now, and we just parachute them in and then help with the fundraising. These are the two ways of not running out of cash. You're going to get your cash from customers or from investors, and you unfortunately have the ability to lower costs with a riff from time to time. But let's close out on talking about your journey of raising LP capital. For most people, raising LP capital is the worst and hardest and most painful and disgusting side of the vocation. And I've been involved in helping you guys raise some LP capital. What's your journey been? What can you share and commiserate about how painful or what works, what doesn't work?
So at a high level, what we thought would work at first just didn't work and bombed. So we went out just telling investors exactly what we thought we were: quantitative, data-driven approach to, very early stage, pre-VC stage startup investing. Well, back in the early 2010s, the word quantitative was a bad word because the general view was, well, quants had caused the 2008-9 financial crisis. And, I don't want to look at anything quantitative. It's shocking the percentage of investors that thought that back then, whereas now data-driven, AI, quantitative is all like positive things. So, so we got a little more in vogue there. But our biggest challenge is we break virtually every perceived best practice in the venture capital world. And we don't, we're ultra diversified, and everyone believes that small concentrated funds are the only ways to make money. For a variety of reasons, we don't do any.
Didn't Ron Conway kind of break the ice for you? I mean, Ron Conway with Sun Topher,
People's view was
he stopped raising LP money now.
Was that he just got lucky on a few in general, like, or he was an anomaly. It's just they didn't. It's no. I mean, I'm amazed at how many. I don't think it was until AngelList did their report about power law. Like, I mean, we understood power law math. We did a lot of math before we launched all on power law distributions. And it wasn't until AngelList put out the report, I don't know, like early 2020s, that even the concept of power law or diversification started not being a bad word. So yeah, and it's still a challenge. So that diversification part, we don't do follow-on funding. And everyone thinks that's insane. How do you protect your ownership? All this. And, for us, it's signaling effect. We're the only professional investor in. If we invest in the next round of 15% of our companies, the other 85 just go to zero. They can't raise because everyone's like, oh, well, Right Side Capital knows more about you. They picked their winners already. It's harder.
I used to worry about negative signaling, but like, look, your fund, my fund, we're not Kleiner Perkins. We're not Benchmark. These big boys can do their own math. I mean, maybe we're not as good at raising LP money as they are.
But in the less frothy times,
fund.
Yeah, but at the early
the multiple's not good enough for me. Like the reason we're not doubling down in this $100 million round is that we got to exit at 2 billion to make a 10x. That doesn't impress my wife or kids. 10x. So we're looking for bigger multiples. So it's not a negative signal. We might even do an SPV to put money into this 4xer. But so I don't buy the negative signal thing for a fund like yours or a fund like mine. It's a negative signal for Benchmark. They should get out of seed.
I'm not talking a negative signal at Series A or anything like that. No one cares if we're in on a Series A or not, or even a seed round. I'm talking negative signaling for that next round, which might be another 500K round or 750, right? So that's where it's really problematic. And it just causes more harm to our portfolio than any gain we get from picking out those few where we have information. So like, it's really important for us that our portfolio raises on a level playing field, like that we're not sending that signaling effect out. And we do that either by not investing in any next rounds or in sort of structured way investing in all of them. We've never had enough capital to even consider that. And it's worked out incredibly well, at least from our perspective. And I've known people at this very early stage who've done it and followed on, and it works great. And it's not an issue for a number of years until all of a sudden it's an issue, and it's a really painful issue. Okay. But anyway, there's other reasons too. We don't do it because every later round is a lower risk profile and reduces your returns, right? There's lots of reasons for it. And then the last thing, we don't take board seats early on. It's just all these things that we do, and we don't care about ownership percentage. We're valuation sensitive. All these things that go against everything that everyone had been taught were the best practices in VC. So I'd say that's just been our biggest issue. So almost all of our investors, it's only until pretty recently when our track record started hitting people over the head that we'd started getting some institutional LPs. Traditionally, it's just when that many things go against the grain.
What was the persona of an LP before you broke
even still today,
ceiling?
Almost all of our investors tend to be individual investors or small family offices. So it's individual investors, it's investors from a lot of wealth shops, small family offices. We are not getting dollars from fund of funds, from traditional institutions. It's almost impossible. Like for us, what we've discovered in a lot of those organizations, we get some internal champion that's done the research and loves us. And then they take us to the investment committee, and you got to get through 5 people, and each one could be mortally offended by any of those best practices that I just said that we break. And then it dies there. And that just happened over and over again, where we had this champion and we just die at the committee. And we thought, all right, well, this isn't the right investor profile for us. But you know what? The upside is it's so much more rewarding making money for people that you feel in touch and have a relationship with.
Well, you get a network. You get a network as well. Those people can. They all have a Rolodex, and they can meet the startup and add value, parachute in, and teach them sales teams and how to build a sales force and all that jazz.
Yeah. So I mean, it's a much different world for us now, fundraising. But I mean, those were in the 2010s. Those were all the biggest pain points for us. Yeah. We sort of zigged and zagged. I'd say when the venture world was raising money hand over fist and everyone was throwing money in, it was hard for us to fundraise because we just look so different, and we're breaking all these perceived best practices. And now in a period where I think it's probably the most difficult time maybe ever for the venture world to fundraise, for us, it's actually as best. It's still hard, but it's easier than it's ever been for us.
Yeah.
Still,
I mean,
we
it's
sort of just
easier.
zigged and zagged, opposite of the market.
I mean, you guys were 2 years ahead of us, but raising for a first-time fund without any exits is hard. And so it's getting much, much easier for us as well, because you can now show, we're top decile or whatever. And so people just look at the numbers. Closing out on how many other companies do you see operating in the pre-VC or pre-seed? I mean, I know there's been, in the last 10 years, a whole lot have popped up in New York City. I always think of Ron Conway as Silicon Valley Angel, SV Angel, as the godfather of this
Absolutely.
space. It's not exactly competition. It's more of like you can collaborate and fill these rounds together. Like how many do you think even exist? How many of these things exist that are
I think
remotely looking like Brightside? Like 300 million, like 250 companies in one fund over 3 years.
Almost nothing. It's almost all startup accelerators, that any of the large startup accelerator organizations that have those amount. There are a few other players that do it, but in general, most of the people, and I'd even guess that even in New York City, where you're talking about, what we find is there's a lot of pre-seed stage investors that might write check sizes similar to what we write. Yeah, they write 250K checks, but they don't write 250K checks into 250K rounds or even 500K rounds. Like once in a blue moon, they're 250K into $1.5 million pre-seed rounds. That's typically what they're doing. So I think there's a lot of investors that deploy check sizes that are similar to us, but they don't deploy them into this 100 to 500K rounds. Like that's the part of the entrepreneurial world that's just not getting addressed so much.
Okay.
And I think there's a lot of unmet demand. So I think that's the biggest difference. And yes, there are other people out there. And I think Ron Conway is definitely the godfather of, being able to say, hey, I understand that it's a trail driven market here and I need to be ultra diversified. And he was a decade ahead of everyone else. I think 500 Startups was probably the next, who was actually out there early in the 2010s saying, hey, diversification is your friend, not your enemy.
I know Dave well. Dave was terrified of having a concentrated portfolio that could all sink to the bottom of the ocean. He was just terrified of that. He was raising money in this hand and deploying it immediately in that hand and just going fast, fast, fast. And with no track record, he's like, let me show you some companies I'm funding.
Yeah. And I would say that in the 2010s, I would have generally said philosophically, we're probably the most aligned with them. I think the difference is 500 Startups would deploy a lot of cap. They did a lot of follow-ons. So a lot of the capital would still be deployed at a seed and a Series A round. And so, whereas we're deploying all of our capital into this sort of unique stage.
Yeah, he was big on the Gordon Gekko legal insider trading.
But that concept that like diversification is your friend and not your enemy, like he was the first person that was saying that out loud aggressively in the 2010s from our perspective.
Yeah. He did a lot of good things. Final question, geography. What have you learned about investing geographically outside of Silicon Valley and New York? Obviously, you invest everywhere. Are you USA only, or do you do Canada too, right?
We're USA, Canada. We will occasionally invest overseas. It's just much higher bar. You generally have to be much higher levels of our traction, valuation to traction, more attractive to us. There's just a lot more, for overseas companies. I said that 1,000 to 1,200, investor network that we have. Most of those don't invest overseas. So like we can't help you as much.
That's
if you're overseas. There's not as much exits for companies that aren't based in the US or maybe in Canada. So, the biggest challenge we just see is to have a good investment outcome, you have to have both a good company outcome and an exit eventually. And it's just harder in other parts of the world. There's not as many exits. There's not as many. It's harder to get follow-on rounds. So we're mostly US and Canada. Within those, we're investing everywhere. If you had talked to me in the early 2010s, we hardly did very few investments in the San Francisco Bay Area, New York City area, because we'd just rather have the same profile of company that was in San Diego or Omaha, like where the cost structure
So
was
it was,
just
it's
much
probably
lower.
hard to get, it was hard to get under 3 million valuation probably, right?
But
Like,
it's fluctuated a lot over time. Like these early stages, in that for the 2012, 13, 14, valuations at those stages were crazy in San Francisco. And then they actually crashed down in over a couple year period. But also just as companies started, the norm of the companies that we invest in is they've got, it's a technical founder or two with overseas dev team. And now, whereas back in 2012, 13, 14, every dev teams were in-house still mostly. So, a team of 5 developers in Atlanta was so much cheaper than a team of 5 developers in San Francisco or New York. But in today's world, we're investing in San Francisco, Bay Area, and New York all the time because it might be 2 founders, one's technical, and they've got 8 developers. But those developers are in Colombia, Poland, Pakistan, you name it. And so you don't have to necessarily have this high cost structure anymore. I mean, particularly in San Francisco, rent's almost free, so if rent's free and there's most of your employees aren't here, it doesn't matter that you're based here like it used to.
okay. And I promise final question. What do you think about safes, convertible notes versus price rounds? What do you guys typically see? Because the size of the round is small. You don't want a big percentage going to a Oric or
So over time it's changed. So when we started in 2012, 13, we came up with our own custom Series Seed docs. This was even, I think, before the SeriesSeed.com docs had came out. And we were getting price rounds done for a total cost of $3,000 for when we did
awesome.
our first year.
Can you do that
year and a half? Then we switched as convertible notes took over the world. We switched to convertible notes with caps, and now it's almost entirely safes with valuation caps. The whole goal is to make sure if a company is raising 100,000, 250,000, I want as much of that going to the company as possible and not disappearing illegal.
I like your $3,000 priced round and get the clock ticking on QSBS. There's a lot of reasons why I don't like safes, but do you believe that when you wire money on a safe, you've started the clock ticking on QSBS or not? What's your view of this?
I will give you our view, and God, I wish the IRS would just give some clarity. Here's our view on it and all of it. With 100% certainty, convertible notes the clock in QSBS doesn't start until they convert.
Right.
Once you get to safes, it's a no man's land. We are fairly confident. I'd say we've had very high confidence that the clock will most likely start at time of investment in the safe for post-money safes, because post-money safes have been restructured. There's a whole last paragraph wording saying both parties that believe that for these purposes, this shall be considered common stock. It acts like common stock. It's diluted by increases of a stock option pool that happen in a round. It receives dividends if dividends are paid out. Everything about it is to be stock-like. So our belief is that the clock should start then for post-money safes. And for pre-money safes, I know talking to Y Combinator, their intention was always that these be considered equity. That's a grayer area, and we have less confidence that the IRS, if they ever rule, will rule like that there. So, but I believe that the way post-money safes are structured, they are effectively like common stock. I mean,
my view is calculate
like
the tax calculate the tax that you would have paid for if you didn't hit full QSBS after conversion on a post-money safe, and keep that money in a money market fund in case there's ever a clawback with the courts ruling on it.
It's incredibly frustrating.
It's unclear.
It hasn't been ruled on because it's not like, it's annoying. There's no safe way to do it. Like, it's annoying because either way, if you're wrong, you have to refile all these back tax returns and push all this stuff out to your investors differently.
Nightmare. Yeah. Okay. Well, listen, Dave, thank you so much for taking the time. We're super excited to continue to keep working with you guys and keep rocking. Clearly, there's a huge demand in the market for what you guys do, and it's great to see time has proven you're making kick-ass returns.
Yeah, anytime. Always happy to come on and talk.
Okay, man. See you soon.
All right, great to see you.
Bye for now.
Bye-bye.